Okay, let's cut right to the chase. There's been a definite shift in the markets recently, hasn't there? A real sense of relief, maybe. A rally that seems, well, pretty clearly tied to easing trade tensions. It feels like things turned around quite fast.
They certainly have, yeah. And that pivot is exactly what we're diving into today. We're unpacking a recent global market outlook report, specifically dated May 23, 2025.
Right. So our source material for this deep dive is this one. Detailed report packed with data, insights. I mean, straight from experts looking ahead at the global investment landscape.
That's right. And our mission here really is to distill what's actually driving this tariff relief rally that the report talks about. What the experts inside it are recommending you should consider doing next, and what all of this could potentially mean for you and your investments as we look forward. We're going to try and slice through the noise, find the most important takeaways.
All right, sounds good. Let's unpack this then. The biggest headline from this report, like right at the top, it's a major pivot in their stance. The experts have upgraded global equities to overweight. Think of that as a strong signal saying, the tide is turning, maybe time to lean in on stocks.
It's definitely a significant move. And the core forces they cite behind this upgrade are, well, basically twofold. First, a noticeable reduction in U.S. trade policy risks, which we just mentioned. And second, a sharp improvement in market technical indicators.
Okay, so a combination of policy hopes and, market mechanics.
Yeah.
But they don't just shout buy stocks, right?
Yeah.
The report is careful to highlight what's needed to keep this rally on track. What are those conditions for sustainability?
Yeah, good point. For this rally to actually endure, the report points to two crucial areas. First, we need to see actual follow-through, so more trade deals actually being concluded. And second, continued resilience in economic activity data, what they call the hard data, and importantly, in corporate earnings estimates too.
Interesting. Okay. They also make specific regional calls within that broader global equity view. Where are they directing that new emphasis?
Well, they've moved to a small overweight position in U.S. equities. Their argument is basically that the earlier Sell America trade was probably overdone, given the resilience we've seen. And within Asia ex-Japan, they are explicitly overweight China. That's driven, the report states, by expectations of domestic policy stimulus and a softer U.S. dollar.
And beyond equities, did the report see any notable shifts in other areas, like bonds or commodities?
Yes, definitely. They've downgraded gold to just a core holding now. They're anticipating a period of consolidation after its recent strong run. But they still find high-quality bonds attractive, especially given the current elevated yields available.
This recent turn, it feels sudden, but the report connects it back to something specific. This roller coaster we've been on with U.S. trade policy. How does it describe that ride?
It uses the phrase blowing hot and cold, which feels about right. I mean, think about the volatility just in the last couple of months. You had Liberation Day on April 2nd, which actually brought higher than expected tariffs initially. Then just a week later, April 9th, a sharp reversal, a pause on most tariffs for 90 days to explicitly focus on trade talks. And more recently, we've seen movement like the outline of a potential deal with the UK and the start of U.S.-China trade talks.
Wow, yeah, that's a lot of policy whipsaw in a really short time. How did the markets react to all that uncertainty?
Well, the report notes that markets pretty much mirrored this policy flip-flop. The S&P 500, for instance, it fell about 20% peak to trough during that period of maximum uncertainty before recovering significantly and actually turning positive year-to-date recently.
That recovery really underscores the point about policy relief driving the recent move, doesn't it? But the report is also clear that risks haven't just vanished. What are the key event risks they highlight looking ahead?
There are two primary risks on the radar, really. The most immediate is the outcome of these trade policy discussions, particularly as that 90-day tariff pause is set to end in early July. That's a key date. The second is the resilience of economic data, whether the recent positive signals actually hold up.
Speaking of data, what's the report's expectation there? We've heard some mixed signals, especially from, the surveys.
Yeah, the report anticipates relative resilience in the hard economic data, so the actual measures of activity, even though recent soft data from sentiment surveys has shown some weakness. They also mention that potential progress on deregulation could provide a degree of economic support.
Okay, so given these lingering risks, especially the trade uncertainty, why upgrade equities now? What's the core rationale behind this shift?
This is where the report leans pretty heavily on that second factor we mentioned earlier, the sharp improvement in the near-term outlook. And that's driven specifically by technicals.
Right. And how exactly are these technicals signaling improvement? What are they seeing?
So the report references their specific quantitative models. Their short-term models, based on price action, trading volumes, that sort of thing. They've turned outright bullish for both US and China equities. The expectation from these models is a test, or maybe even a break, above the S&P 500's prior record highs. And even their longer-term stock bond model is now modestly bullish. And they explicitly note it's also driven by technical factors, not necessarily an improvement in fundamental economic drivers just yet.
Okay, so the technical momentum is a major component of this bullish call, and they see a specific window for this to play out.
Yes, exactly. They highlight the period leading up to early July, when that 90-day tariff pause expires. They believe this window creates room for equity momentum to run further, particularly if we see more progress on, say, trade deals, deregulation, or the tax agenda.
What about corporate earnings? We've just finished the Q1 U.S. earnings season. How did that factor in?
Well, the Q1 U.S. earnings season was actually strong. Pretty solid. The report uses this performance to kind of bolster their view that the Sell America trade we saw earlier was likely excessive. Earnings proved more resilient than maybe people anticipated.
Okay, so we have improving technicals, solid earnings supporting the U.S. picture. But the report keeps emphasizing diversification. Why is that still so critical, even with a more bullish equity view?
Yeah, that's a really important question. Even with the overall upgrade, the report strongly stresses the absolute importance of ensuring you are adequately diversified. Across major global regions, they see areas like the Euro area and Asia ex-Japan equities, not just as footnotes, but as, core holdings,
Yeah.
where any market pullback should actually be viewed as opportunities to rebalance your portfolio back into them. They also continue to hold India as a core position, citing the potential for a U.S.-India trade deal, strong underlying earnings growth, and ongoing foreign investor inflows.
Let's dig into the specifics then on their views on individual asset classes. We mentioned gold was downgraded slightly. What are the price expectations going forward?
So they've moved gold to a core holding. Their near-term expectation, say 1-3 months, is for some consolidation around USD 3,100 per ounce. Looking further out, 6-12 months, they still anticipate a move towards USD 3,500 per ounce. And that's largely driven by the expectation that major central bank buying will resume later in the year. They do note that price sensitivity from Asian buyers is maybe contributing to the near-term consolidation, and they see a baseline floor price for gold somewhere between, say, USD 3,000 and 3,100 per ounce.
Okay. And bonds remain a core holding. Still
Yeah.
attractive.
They do, yeah. Bonds are viewed as a core holding and remain attractive at current yields. The report provides expected ranges for the U.S. 10-year government bond yield, somewhere between 4.00% and 4.25% in their based-off landing scenario, and potentially falling below 4% in a hard landing. Now, they do acknowledge the risk of yields jumping due to U.S. fiscal deficit concerns, particularly after the recent rating downgrade, but they view this as more of a tail risk, less likely in their core view based on historical context. They find attractive value in longer maturity bonds, precisely because they anticipate yields moving lower over time.
How about currencies? What's the outlook for the U.S. dollar specifically?
Their view is for the U.S. dollar, measured by the DXY index, to see a bit of a near-term rebound, perhaps hitting 103 over the next 1-3 months. This is driven by, renewed appetite for U.S. assets in the current environment. However, longer term, they expect it to weaken, potentially falling to around 98 over 6-12 months, as investors rotate out of U.S. assets and also due to the dollar's still kind of elevated valuations. They briefly mention other currencies too, expecting USD to maybe ease near term but rebound long term, and Asian currencies likely staying range bound but benefiting from a softer dollar down the line.
And finally, crude oil. What's the take there?
The fundamental view from the report is that the oil market is likely to remain oversupplied through 2025, partly due to OPEC Plus decisions to roll back some cuts. So they maintain their 6-12-month forecast for WTI crude at USD 60 per barrel. However, in the short term, like 1-3 months, they do expect a rebound towards maybe USD 64 per barrel, driven by anticipated adjustments in bearish investor positioning and potentially positive sentiment from China policy stimulus. Middle East geopolitical risk is noted as the key upside risk that could, change this outlook.
Now let's zoom in a bit. Where does this report suggest the most compelling specific opportunities might lie right now, particularly within equities?
Yeah, what's fascinating here is how they translate that macro view and the technical signals into specific sector and regional calls. Opportunistically, they are turning bullish on U.S.-listed semiconductors. They expect these to continue benefiting significantly from the whole AI trend, noting that the recent Q1 earnings reaffirmed continued robust AI spending growth. They even address concerns about lower cost AI models, things like DeepSeek. They argue that these might actually help expand the overall AI pie, though they do acknowledge lower AI spending is still a risk to watch, obviously.
Right. And any other specific U.S. preferences mentioned?
Yeah, beyond semis, they also favor technology software, citing strong pricing power and benefits from integrating AI tools. They like communications services driven by growth in online entertainment and AI applications. And major banks, which they see benefiting both from a potential soft landing economic scenario and deregulation efforts. Outside the U.S., they highlight Europe banks, particularly those with domestic exposure, expecting support from potential German fiscal stimulus. Europe industrials are also favored, linked to expected increases in infrastructure and defense spending. In China, they like non-financial high-dividend SOEs, that state-owned enterprises, seeing them supported by domestic stimulus and less exposed to property sector risks. And Hang Seng technology stocks, citing policy support, ongoing AI development, and, well, attractive valuation compared to their U.S. counterparts.
Okay, so looking across all those calls, it really sounds like a definite shift towards a more pro-growth stance in equities overall.
Exactly, yeah. The report explicitly summarizes their shift as turning pro-growth. And you see this reflected in the specific sector upgrades and downgrades detailed in the report. For example, U.S. financials, communication services, and technology are now overweight, while more defensive sectors like healthcare and utilities are typically rated neutral or even underweight.
The report also listed some specific opportunistic ideas within bonds. Where are they finding value in the fixed income space right now?
They highlight several areas they're particularly bullish on opportunistically. This includes U.S. 20-year plus government bonds, which they see offering attractive yields right now. UK government bonds, or gilts, especially FX unhedged for investors getting a yield pickup. U.S. agency mortgage-backed securities, MBS. And U.S. Treasury inflation-protected securities, TAPS. These are noted as outstanding opportunistic views in the report.
Okay, so if we zoom out again, the market outlook isn't just a single forecast, right? It's about navigating potential paths. The report outlines several macro scenarios.
It does, yeah. This section is really crucial for understanding how to navigate the inherent uncertainty. The report presents 3 key macro scenarios and actually assigns probabilities to each one.
Okay, what's the scenario they see as most likely? The base case.
That's the soft landing scenario, which they assign a 50% probability, so half chance. In this world, the trade talks yield positive results, maybe a scaled-down tax bill manages to pass, U.S. economic growth slows but avoids a full recession, and the Federal Reserve begins cutting rates, say, in the second half of 2025. The market outcome they envision here is initial volatility persisting near term, but resilient earnings eventually underpinning gains. They have a 12-month target for the S&P 500 at 6,520. In this scenario, preferred assets are equities, emerging market assets, and gold.
Right. What about the potential downside, the less rosy picture?
That's the hard landing scenario, given a 25% probability, a 1 in 4 chance. This is a world where sentiment becomes depressed again, trade tensions flare up, and the hard economic data deteriorates, leading into a mild recession. The market outcome would likely see the S&P 500 falling further, perhaps towards 4,500, and U.S. 10-year yields dropping below 4%, though maybe inflation and term premia could limit how low they actually go. Preferred assets in this downturn would be things like short-dated government bonds, gold, and safe haven currencies, the Japanese yen, euro, Swiss franc.
And the upside case. What if things go better than expected?
That's the no landing scenario, also at a 25% probability. Here, government spending and tax cuts, coupled with deregulation efforts, significantly boost the economy. Trade deals get sealed successfully. And the global economy sees a more balanced, stronger expansion overall. The market outcome is U.S. equities and riskier bonds strongly outperforming, with the S&P 500 potentially rising up to 7,000. But 10-year yields would remain elevated, likely between 4.5% and 5.0%. Preferred assets in this robust environment are U.S. equities and developed market high-yield bonds.
Okay, so 3 quite distinct potential futures, all with notable probabilities assigned. What's the report's overarching conclusion on how to approach this range of possibilities?
Well, the report's conclusion is pretty clear and strong, given the significant uncertainty and the range of potential outcomes. Diversification across asset classes and regions remains absolutely crucial. It's basically your primary tool for navigating these different potential paths.
The report also brings in insights from their quantitative models, offering a sort of systematic, data-driven perspective. What do those models tell us right now?
Yeah, the quantitative models provide an independent view, which is useful. Their stock bond model is currently slightly overweight global equities. What's interesting here is that the model notes that positive valuation and technical factors are currently offsetting some lingering negative fundamental factors. They also mention that this specific model has generated positive alpha recently, so it's been performing okay.
And the technical framework we discussed earlier, what's the summary from the models there? Are they confirming that bullishness?
Yes, the report highlights that the technical framework's quantitative signals are specifically giving short-term bullish calls for equities in China, the US, and also the UK.
Any other noteworthy signals from the models? Anything else jump out?
One other point they observe is that investor positioning in both gold and developed market investment grade government bonds, which had become somewhat overbought back in April, has now normalized. So less crowded trades there now.
Okay, so this deep dive started with a market rallying on trade hopes and technical signals. We've explored the underlying drivers, the risks, mapped out potential future scenarios. But how does all this connect back to your personal wealth, your investment plan as a listener?
Yeah, this raises a really important question for you, the listener. The report shifts perspective here to emphasize some fundamental wealth management principles, reminding us that time is, well, a precious commodity, and regular review of your investment plan is pretty essential.
And it poses some direct questions for you to consider based on everything we've discussed, doesn't it?
Yeah.
Like homework.
Exactly, yeah. It asks you directly, are you potentially holding too much cash right now, given the outlook? Are you sufficiently allocated to growth assets to meet your long-term goals? Is your portfolio adequately diversified to navigate these different potential market paths we've talked about? Are you positioned to potentially capture the specific opportunities the report identifies? And fundamentally, is your wealth working hard enough for you, allowing you to focus your own precious time elsewhere?
The report briefly touches on a today, tomorrow, forever approach as well.
Yeah.
You unpack that quickly.
Sure. That concept is basically about structuring your wealth across different time horizons. Today, for immediate liquidity and income needs. Tomorrow, for medium-term growth and protection against unexpected events. And forever, for long-term compounding and, generational returns over decades. The report links this to timeless investment principles that apply regardless of the short-term outlook. Things like discipline, diversification, the importance of time in the market, not timing it, understanding the link between risk and return, and having adequate protection strategies. These fundamental principles, the report suggests, are really your anchor points for navigating the current dynamic and, frankly, uncertain market outlook.
So wrapping up this deep dive then, we've seen a market shift driven by easing trade tensions and strong technical signals. This led the experts in this report to upgrade global equities, specifically favoring the US and China right now. But, and it's a big but, significant uncertainty remains, particularly around how trade and fiscal policies will truly unfold, painting a picture of multiple possible scenarios with a soft landing, seen as the most likely but far from guaranteed.
Exactly. And the core message distilled from the report really is that navigating this environment requires staying grounded in fundamental principles. Diversification isn't just a recommendation. It's presented as your essential strategy for resilience across these different potential futures. Reviewing your plan and ensuring your wealth aligns with your own long-term horizons, that's paramount.
Okay, so here's a final, maybe provocative thought for you to consider, building on what we've discussed today. The experts' more bullish near-term view is notably driven by technical factors and market momentum, rather than a fundamental shift in the underlying economic picture just yet. How does knowing that change how you think about relying on market rallies? And what does it reinforce about the importance of consistently sticking to your own long-term investment principles, independent of these short-term swings, often driven by technical signals?
Something to think about. How do these insights from the report apply to your own unique investment journey and goals?